So if you're a retiree in Connecticut, you've probably heard the big news for 2025, right? A massive tax cut on retirement income. It sounds fantastic, a welcome change for sure. But the question is it really as good as it sounds? Well, that's what we're here to find out. We're going to take a much, much closer look. Okay, so the official story from the state is that the dreaded tax cliff is gone. You know, that crazy situation where earning just $1 extra could literally cost you thousands in taxes? They say it's a thing of the past. But when you really dig into the numbers, when you do a forensic analysis of the new law, you find out something else. The cliff isn't gone. Not at all. It's just in disguise. All right, let's start with the good news, with the promise that was made. And honestly, on the surface, this all looks great. The state is phasing out the income tax on retirement wealth, and that's a huge deal.
And here it is, the core of the promise. For the 2025 tax year, the rule seems super simple. If your income is below a certain line, your pension and annuity income is 100% tax-free. That's right, zero state tax. That's the big headline.
So what are those magic numbers? Well, if you're a single filer, that magic number is $75,000. If you're married and filing jointly, it's $100,000. Stay under that line, and you are golden. No state tax on that retirement income. It sounds like a simple, clean tax cut. But this is where things start to get tricky.
You see, the old cliff was, well, it was a cliff. One wrong step, and you went right off the edge. This new system, it's different. Think of it less like a single drop, and more like a really steep, really jagged staircase. It might not look as scary at first, but trust me, a fall down these stairs can hurt just as much.
Yeah, this really shows what I'm talking about. Before, it was all or nothing. You were either safe or you fell and lost your entire tax exemption all at once. Now, you go down in a series of these punishing steps. You don't lose it all in one shot, but with each step down, a big chunk of your tax relief just vanishes. Okay, this is probably the single most important detail to understand. The number that triggers this whole staircase of pain, it isn't your Connecticut income. It's your federal adjusted gross income, your AGI. And what does that mean? It means everything gets thrown into the pot. The taxable part of your Social Security? Yep. A one-time capital gain from selling some stock? That counts too. This is the main trap because you could be minding your own business, rebalance your portfolio, and bam, you've accidentally pushed yourself over the edge.
So how bad is it really? Let's get into the nitty-gritty. We're going to do a little forensic analysis on what the state calls a phase-out. This is where you can really see the hidden danger of these new steps.
Just look at the actual numbers here. This table is basically the blueprint for that jagged staircase we're talking about, specifically for a single filer. Notice, the deduction doesn't just gracefully taper off. Nope, it drops off in these massive 15% chunks at very specific income points. These right here, these are the new mini-cliffs.
So let's make this real. Imagine you're a single retiree with a $60,000 pension. For someone in this position, your financial planning for the year is absolutely critical.
Let's say after adding up all your other income, a little bit of interest, maybe a small dividend, your total federal AGI comes out to $77,499. You are literally one single dollar away from a critical threshold. At this income level, you're in a pretty good spot. You qualify for an 85% deduction on your pension. That means only $9,000 of your $60,000 pension is subject to Connecticut tax. So far, so good. You're feeling pretty safe. But then what happens? What if a mutual fund pays out an unexpected $1 dividend? What if you find an extra dollar of interest in an old savings account? What happens with that single extra dollar? That tiny change pushes your federal AGI to exactly $77,500. And that number, that is the precise edge of one of those steep steps we just saw, and the consequences are huge. And boom, by crossing that $1 line, your pension deduction plummets from 85% all the way down to 70%, instantly. So the taxable portion of your pension just doubled from $9,000 to $18,000. Think about that. That single dollar of income just made an extra $9,000 of your pension taxable. Let's put that in real money terms. At a 5% state tax rate, that's an extra $450 in taxes you now owe, all because of $1. If you do the math, that's an effective marginal tax rate of 45,000% on that $1. This is the stealth slope, and it's the dangerous new reality of the tax cliff. And just when you think it can't get any more complicated, it does.
Because for tax year 2025, there are two other compounding traps working in parallel, creating a potential double whammy at the very same income levels. First up, if you take money from an IRA, listen closely. There's a special rule just for 2025. Only 75% of your IRA withdrawal is even eligible for this exemption. The other 25%, it's automatically taxable no matter what your income is. It creates this confusing double math you have to do to figure out your tax bill. And second, there's a parallel cliff just for Social Security. If you stay under that 75K or 100K AGI line, your Social Security is completely exempt from state tax. But the second you cross that line by $1, it's not a phase-out, it's a hard switch. You can suddenly face state tax on up to 25% of your benefits. This means you can lose a chunk of your pension exemption and your Social Security exemption at the exact same moment.
So yeah, the whole system is basically a minefield. But here's the good news. It's a predictable minefield. And if you know where the mines are, you can navigate right around them. With the right strategy, you can absolutely navigate these stairs and protect your wealth.
So what do? Here's a simple but powerful asset defense plan. Number 1, forecast your Federal AGI in November. Don't wait until tax season when it's too late. Number 2, be extremely careful with capital gains. Selling a big stock position could trigger that massive tax penalty. And number 3, if you're over 70.5, use what's called a qualified charitable distribution, or QCD. Giving to charity directly from your IRA actually lowers your AGI, and that can be the very thing that keeps you in a safe tax bracket.
You know, this quote from the source analysis really just sums it all up. If you manage to stay under these AGI thresholds, Connecticut becomes one of the most generous tax havens for retirees in the whole region. But if you accidentally step over that line, it quickly becomes one of the most hostile. The stakes are incredibly high.
So, which is it? Is Connecticut a tax paradise for retirees or a perfectly designed tax trap? Well, for 2025, it's actually both. And the difference really just comes down to one thing: knowing the rules. The power to decide which side of that line you land on is entirely in your hands.